So, you're a first home buyer. Hello and welcome. I'm George Norrie, and as a licensed mortgage broker and real estate agent for many years, I understand that this is a very exciting time in your life. There is so much to discover and understand about the process for both finance as well as property that it can be very easy to get confused and frustrated. But having helped so many first home buyers in the past, I know that we can help you navigate through these challenges and make it the great experience it should be for you. There comes a time in your life when you want to buy a home of your own. You have some idea about what you want to buy and where you want to live. You have some savings, but you don't know how much you can borrow. What you may not know is all of the steps that you need to take to make this dream come true. But also on top of that, did you know that there are 105 home loan lenders in Australia at this time, and there are over 5,000 home loan products to choose from? So, where and how do you start? Well, that's what this video is all about. So let's get started on exploring this journey together. Where can you go to get some information? Where can you get some help to get started? Well, you have four choices. Your first choice is to go directly to a bank. Now, the only choice you will get here is what that bank wants to sell you at that particular point in time. What they won't tell you is what is available at any of the other banks or financial institutions, let alone whatever specials may be on offer at that time. Your second choice is to get information online. Now, I just mentioned a moment ago that there are 105 funders and over 5,000 home loan products on offer at this point in time. Now, that's an awful lot to wade through on your own. Yes, the internet is fast and it's convenient, but I think it's only fair to say that you just don't know what you don't know. It's like visiting Dr. Google and hoping for a cure for whatever ails you. How much trust can you really place in that? Your third choice is to go to a mortgage broker. Now, a mortgage broker will offer you a selection of filtered choices that will be tailored to your specific needs, so a clear choice. Choice number 4 is to come to the House Strategy Group. Now, for most people, buying your first home will be one of the biggest decisions you've ever made to this point in your life. Taking out a mortgage will also be the biggest loan you'll ever undertake, and it will most likely be part of your financial situation for many years to come. I want you to know that we take a personal interest in your success and will be there with you every step of the way throughout this entire journey. We're not just here for your first home loan, and you mean much more to us than just the transaction. We've worked for many years now with both finance and property and have a deep understanding of the synergies between the two and how to get the most benefit out of both. Your first home loan, as with all subsequent loans, will always be structured with your future goals in mind. Our commitment to you as your finance and property specialist is that we will stay well informed on these ever-changing landscapes in order to continue to offer you the most up-to-date information for whenever you may need it. When you establish a relationship with the How team, this relationship will be the one constant throughout the life of your mortgage, even if you change lenders along the way. Through regular contact, we will get to know you and the ever-changing events in your life that may trigger a review of your financial situation. As your circumstances change, we will ensure that any loans that you have in place are still the most suitable for your personal needs. We will provide you with any education understanding that you require so that you can make informed decisions whenever you need to make them. This is the real point of difference that you'll experience with the How team. Now, the first question I've been asked by just about every first home buyer that I've ever met is, how much can I borrow? Well, that's a great question, but it's only half of what needs to be asked. What needs to be asked is, firstly, how much will the bank lend me? And that's known as your borrowing capacity. The second question is, how much deposit do I have? And that's known as your buying power. Now, those two answers combined will tell you what you can afford to buy. Now, to help you understand the basics, let's start with a case study. And let me introduce you to Peter and Mary. Before they begin this journey, they need to demonstrate their ability to repay the loan to the banks. So put simply, this is accomplished by taking into account all of their income and expenses, and whatever's left over will determine what their capacity is to make mortgage repayments. So fairly common sense. So let's go through the 6 steps that you need to understand to make sense of this whole process. Step number 1, the first thing the bank wants to know is how much Peter and Mary earn and what they spend their money on. So working through this exercise with Peter and Mary, we have established the following. Their combined net income after tax, in other words, their take-home pay, is $8,496 a month. Their combined living expenses for that month is $3,300. They have one external loan, which is for a car, and that's $889 a month, and they're currently paying $500 a week rent. Now, you'll notice that we haven't taken the rent into account in this exercise purely and simply because when they buy their first home and move into it, obviously they're not going to be paying rent anymore. So the total monthly outgoings is $4,189, which gives them a net cash flow position every month of $4,307. That's a very healthy position to go searching for a home loan with. Okay, so step 2. Based on Peter and Mary's income and expenses, we can now determine how much different funders were prepared to lend them. We identified 26 funding choices available to them, offering between $566,000 to $626,000. We later narrowed these choices down to 3 as being more appropriate to their needs. You will note there's a difference of almost $60,000 between the funders, and this is due purely to the different policies applied by each of the funders when assessing Peter and Mary's ability to make repayments. So we now identified how much Peter and Mary's borrowing capacity is. And this brings us to step 3. How much deposit do Peter and Mary have? Well, now that we know how much they can borrow, the next step is to determine their buying power. As first home buyers, they also want to take maximum advantage of the first homeowner's grant. So their deposit was made up from the following. They have combined savings of $25,000. They have the first homeowner's grant of $10,000. From the bank of mum and dad, they have a gift of $6,000, which gives them a total of $41,000. We now know what their buying power is at $41,000. So step 4. Knowing Peter and Mary's borrowing capacity and buying power, we can now determine safely what they can afford to buy. So let's weigh up some facts. Their borrowing capacity was good, with ample funders to choose from. Their buying power was a little on the low side, but high enough to move forward. Lenders' mortgage insurance would be required to increase their loan amount while keeping it still affordable. Unfortunately, their parents did not have sufficient equity in their own home to help Peter and Mary, and I'll touch on that a little bit more later. A suitable amount of cash needed to be set aside as a buffer to meet any future unforeseen expenses, also known as your sleep at night money. They wanted to maximise the benefit from their first homeowner's grant, and they also wanted to avoid paying stamp duty. So Peter and Mary decided to cap their purchase price at $600,000, and as the purchase price was under $650,000, there was no stamp duty payable. Now, I want to take a moment here to give you a clearer understanding of lenders' mortgage insurance and how it works. Mortgage insurance is a one-off premium paid to secure additional funds to make a property purchase where those funds are not available at the time required to complete that purchase. It's an insurance policy designed to protect the bank in case of default by borrowers. It applies only to loans exceeding 80% of the purchase price, which means the buyers would need a 20% deposit. In Peter and Mary's case, a 20% deposit amounted to $120,000, which they simply did not have. They chose, however, to use a 5% deposit or $30,000, which would leave them with a buffer of $9,000. And as we mentioned earlier, that's a very comfortable position for them. The good news, however, was that the cost of the mortgage insurance was $17,100, and it could be added to their home loan and repaid over the term of the loan. Their ability to serve this increase in their loan amount was comfortably affordable for them. Now, the other alternatives to avoid the need for mortgage insurance altogether were, firstly, if their parents had been able to act as guarantors on their home loan to bridge the 15% gap or $90,000 in deposit value, but unfortunately this was not an option for them. The second option was for Peter and Mary to save the required $90,000 but this would have taken them 24 months. And they would then run the risk of property prices going up in that time, possibly making the purchase unaffordable. So they decided to proceed with the mortgage insurance option. So let's move on now to step number 5, establishing the purchase structure. Now, the maximum purchase price decided upon by Peter and Mary was $600,000. Now, to this we add the estimated purchase cost to cover legal expenses and registration costs of $2,000. So the true total cost of that purchase is $602,000. Payments required up front were 5% of the purchase price at $30,000 plus the $2,000 in estimated costs, $32,000 in total, which left us with a loan amount required of $570,000. Now, to this, as mentioned earlier, we could add the mortgage insurance cost of $17,100, so the total end loan amount required was $587,100, which left us with funds remaining as a buffer position of $9,000, which is a very healthy position for first home buyers to have when moving into their first home. So step number 6, house hunting with confidence. Now that Peter and Mary had a better understanding of what may be possible for them, the next step was for us to arrange for their home loan to be approved in advance before they started their search for the new home. A pre-approved loan gave them more confidence when talking to real estate agents, as it placed them in a position of ready to buy now. There's nothing agents like more than to talking to buyers who are cashed up and ready to buy. We also provided them with a property assessment on the home they were keen on buying to give them a better idea of the true value of that property. So, armed with the home loan pre-approval and the property report that we provided Peter and Mary, they were able to negotiate a discount on the sale price of the property from $615,000 to $600,000, which made them very happy indeed. Now, if Peter and Mary were to go directly to a bank, they most likely would have been offered a very basic home loan structure. It is likely that before approving their home loan, the bank would ask Peter and Mary to open a savings account with that bank as a condition of securing a home loan with them, so that mortgage repayments can be made directly from that account. Now, having done that, the bank would then most likely offer them a standard variable home loan product with principal and interest repayments for a 30-year term. In addition, they would have direct access for cash via a debit card attached to that savings account, which is standard. It is likely that the bank would also offer them a credit card facility with that bank as an upsell. This is a structure that we would not recommend to any of our clients. This structure benefits the bank, not Peter and Mary. This structure is a 30-year commitment to that bank. Now, our view was to offer Peter and Mary a home loan structure with a personalised strategy behind it to help them achieve their life goals. To begin with, we would recommend a loan facility with 2 accounts, not 1. The first account would be a 2 or 3 year fixed rate facility to lock in an interest rate with a known repayment amount each month for the term of the fixed rate. This facility would then be reviewed at the end of the fixed term to determine any need for variation to that structure that would give them a further strategic benefit. Now, penalties may be incurred if this loan is paid out before the end of the fixed term, but usually offers the ability to make smaller capital reductions each year. The second account would be a variable rate facility that could see the rates go up or down during the term of the loan, but it has no restrictions for any lump sum payments to any amount or even a complete payout of the loan at any time. Now, the next step was to open an offset savings account which will be connected to the home loan accounts and into which all of their wages are deposited. The advantage of this structure is that all the interest earned in this account is automatically offset against the interest charged on the variable loan account every month. It should be noted that this benefit, with few exceptions, only applies to variable accounts. Now, both loan accounts will have their monthly repayments transacted automatically from the offset account. A debit card is also attached to the offset account to give them access to cash when it's required. A credit card facility may also be on offer, but it's not mandatory. This structure benefits Peter and Mary over the banks. This more strategic loan structure can save Peter and Mary thousands of dollars and many years off the term of their home loan. To recap, the structure Peter and Mary chose was a split loan facility with repayments to be either interest only or principal and interest. We did not recommend the interest only repayments as there was no specific need to retain greater cash flow for them for any other purpose, such as for the purchase of another asset or to pay for a special event. Their focus was to pay down debt as fast as possible, so principal and interest repayments were the preferred option. As a result, Peter and Mary's combined monthly repayments are $2,803. We established earlier that their net monthly surplus income was $4,307. So after mortgage repayments, they have a new net monthly surplus of $1,504. This is a very healthy cash position to be in with their first mortgage. So how can we now maximise the benefit of having these surplus funds? Now let's take a look at the maths and the resulting impact of applying these surplus funds to offset interest charges by letting them accumulate in the offset account each month. As you can see in this calculator, by depositing an additional $1,504 each and every month into their offset account, Peter and Mary would benefit by an accumulated saving of $224,906 in interest charges alone over the term of the loan, which as a result would also cut 14.8 years off the term of the loan. This means that Peter and Mary would effectively have paid off their mortgage in half the time. Now, of course, there are many factors that could come up in life, such as lifestyle changes, buying cars, going on holidays, starting a family, getting pay rises. The list can go on, all of which could affect this rate of progress and have an impact on the final result. But at least they know what's possible, and at least they have the resources at their fingertips to monitor their progress and tweak things as they go along this journey to stay in control. But believe it or not, this can also be taken one step further. To get an even more benefit from this strategy, Peter and Mary understood that by learning to live off their credit card, and by that I mean paying as much of that $3,300 of expenses identified earlier on their credit card instead of cash, they could be living off the bank's money for free each and every month, but they had to do it responsibly. For this to work, they must pay the credit card out in full every month, by or just before the due date, without fail. This way they will never pay any interest on the card. No matter what the interest rate is charged on the card, it really doesn't matter. And it will save even more time and more money off their mortgage. That way, if their established expenses of $3,300 was to sit consistently in their offset account, they would benefit from the compounded savings in interest charged on their home loan over the life of the loan. And as an added bonus, as their card is one that earns them points, they will also enjoy the benefits of free travel as well. A little discipline can actually go a long way. So let's recap on what you've learnt today from Peter and Mary's experience. You've learnt about how borrowing capacity and buying power are connected to help you identify the affordability in purchasing the property of your choice. You've learned about the pros and cons of mortgage insurance, and you've learned about the overwhelming number of funding choices that exist in the marketplace today. You've learned that home loan strategies can be tailored to your particular needs. You've learned about debt and cash flow management strategies and how they can help you move forward. You've learned about the value and power of having a home loan pre-approved before you go shopping for that home you want to buy. You've learned about the value and power of property reports so that you can understand exactly what it is that you're buying. You've learnt that armed with these tools, you have the opportunity to negotiate. The ultimate message here is that you have the ability to take control of your own future. You can utilize a strategy to pay your home loan off faster if that's what you want to do, or you can become an investor and follow a planned strategy to help you grow a property portfolio. I have many examples of my clients who started off as first home buyers and have over time moved on to grow property portfolios, and are well on their way to choosing their desired level of financial security. And the same can apply to you. You too can secure your financial future. Whatever direction you choose to take, it all starts from here. I hope you found the information in this video useful and are motivated to take some action, no matter what level you are at as a first home buyer. If this video has raised more questions about what you think you can do, that's great. If you have difficulties getting the answers that you need, call me and I'll give them to you. There is always an answer out there with your name on it. So thanks for watching, and bye for now.